What if I told you that trying to pick the single best investment is actually the fastest way to lose money? And the secret to staying rich is doing absolutely nothing with your portfolio. It sounds counterintuitive, doesn't it? We live in a world that glorifies the hustle, the pick, and the big win. We see headlines about someone turning $10,000 into $1 million by betting on one specific tech stock or crypto coin. It's exciting, it's tempting, but it's also dangerous. Welcome back to Fiscal Beacon, where we cut through the noise and help you build real, sustainable wealth. Today, we're talking about the most important concept in investing that most beginners ignore. It's called diversification. And no, it doesn't mean buying 50 different stocks because you read a blog post last week. It's about strategy, psychology, and mathematics. By the end of this video, you'll understand exactly what diversification is, why it's often called the only free lunch in finance, and how you can apply it to your own portfolio today. Let's dive in. So, what exactly is diversification? At its simplest, diversification is the practice of spreading your investments around so that your portfolio isn't reliant on the performance of a single asset or even a single sector. Think of it like a safety net. If you're a tightrope walker, having one safety net is good. But if that net has a hole in it, you're in trouble. If you have multiple nets or nets in different places, the chances of you falling through completely drop to near zero. In investing terms, diversification means owning a mix of assets that don't move in perfect sync with each other. When one part of your portfolio goes down, another part might stay steady or even go up. This smooths out the ride. It doesn't guarantee you won't lose money, but it significantly reduces the likelihood of a catastrophic loss. To really get this, we need to talk about risk. Not the kind of risk you feel when you check your bank account balance, but the specific financial risks involved in investing. There are two main types: systematic risk and unsystematic risk. Unsystematic risk is specific to a company or an industry. For example, if you own stock in a specific airline and there's a new pandemic that makes people afraid to fly, that airline's stock might crash. That's unsystematic risk. It's specific to that business. Systematic risk, on the other hand, is the risk that affects the entire market. Things like interest rate hikes, global recessions, or major geopolitical events. You can't escape systematic risk easily because it hits everything. Here's the key takeaway: diversification eliminates unsystematic risk. You cannot eliminate systematic risk, but you can manage it. When you diversify, you are essentially saying, I don't know which specific company will win, so I'm going to own a little bit of everyone. Let's look at a real-world example with actual numbers to make this concrete. Imagine two investors, Alice and Bob. Both start with $100,000. Alice believes in the future of artificial intelligence. She puts her entire $100,000 into one high-growth AI tech company. She feels confident. She's done her research. Bob, however, is a believer in diversification. He takes his $100,000 and splits it. He puts 60% into a broad market index fund, which includes thousands of companies, from tech to healthcare to consumer goods, 30% into bonds, and 10% into international markets. Now, let's fast forward 3 years. A regulatory crackdown hits the tech sector. The AI company Alice invested in sees its stock price drop by 70%. Her $100,000 is now worth $30,000. She is in a panic. She has to decide whether to sell at a loss or wait for a recovery that might never come. Meanwhile, Bob's portfolio looks different. The tech stocks in his index fund did drop, dragging his portfolio down by 15%. But his bond portion actually went up slightly because investors fled to safety. His international markets, which weren't affected by U.S. regulations, remained stable. Overall, Bob's portfolio dropped by only 8%. His $100,000 is now worth $92,000. Alice lost 70% of her wealth. Bob lost 8%. Who is in a better position to recover? Who had a better night's sleep? This is the power of diversification. It's not about maximizing your gains in a bull market. It's about surviving the bear market so you're still in the game when the bull market returns. So, how do you actually diversify? This is where most people get it wrong. They think diversification means buying 20 different tech stocks. That's not diversification, that's just concentrated risk. If all those tech stocks are in the same sector, they will likely fall together. True diversification happens across asset classes. The three main pillars are: first, stocks equities. These give you growth. They are volatile but offer the highest long-term returns. Second, bonds, fixed income. These provide stability and income. When stocks fall, bonds often hold steady or rise. Third, alternatives. This includes real estate, commodities like gold, or even cash equivalents. These often have a low correlation to the stock market. A common rule of thumb for beginners is the 110 minus your age rule. If you're 30, you might have 80% in stocks and 20% in bonds. As you get older, you shift more into bonds to protect what you've built. However, for most people, the easiest way to achieve this is through low-cost index funds or ETFs, exchange-traded funds. One single S&P 500 index fund gives you instant diversification across 500 of the largest U.S. companies. A total world stock fund gives you exposure to developed and emerging markets globally. You don't need to pick individual winners. You just need to own the market. Now, let's talk about common mistakes. The biggest mistake investors make is fake diversification. This is when you buy 5 different mutual funds that all hold the exact same top 10 stocks. You think you're diversified because you have 5 different fund names, but if the top tech stocks crash, all 5 of your funds will crash. Another mistake is rebalancing too frequently. Diversification isn't a set-it-and-forget-it strategy forever. Over time, some parts of your portfolio will grow faster than others. If stocks do really well, your portfolio might shift from 60-40 to 80-20. That means you've taken on more risk than you intended. Rebalancing means selling a bit of what's doing well and buying more of what's lagging to get back to your target allocation. It forces you to sell high and buy low, which is the opposite of what our emotions want us to do. But it's what the math says we should do. Finally, a crucial disclaimer. I am an AI, and this is for educational purposes only. I am not a financial advisor. Your personal situation, your age, your income, your risk tolerance, your financial goals is unique. What works for Alice and Bob might not work for you. Before making any significant changes to your investment strategy, please consider consulting a qualified financial advisor who can tailor advice to your specific needs. So, let's recap. Diversification is about managing risk, not just chasing returns. It's about spreading your bets across different asset classes so that no single failure can destroy your financial future. It's boring, it's unglamorous, and that is exactly why it works. In the next video, we're going to talk about asset allocation. We'll break down how to build a portfolio based on your specific age and risk tolerance. You'll learn how to decide how much you should have in stocks versus bonds. If you found this helpful, please hit that subscribe button and ring the bell. It helps the channel grow and brings you more content like this. Drop a comment below. Are you currently diversified, or are you still trying to pick the next big winner? I read every comment. Stay smart, stay diversified, and I'll see